You're watching the Daily Market Comment by Mario Sitchikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. Global markets are torn between different themes, with traders switching back and forth from inflation and recession risks, depending on the latest round of data releases. The week started with the ghost of inflation returning to haunt investors after OPEC Plus boosted oil prices, but the session closed with recession nerves in the driver's seat following a disappointing reading on U.S. manufacturing. Manufacturing activity in the United States contracted for a fifth straight month in March, according to the ISM survey. Since the manufacturing sector is considered the canary in the coal mine for the broader economy, the mounting signs of an impending recession emboldened bets that the Fed will resort to cutting rates later this year. In the markets, the main casualty was the U.S. dollar. The reserve currency absorbed some serious damage as the weakening data pulse gave investors the green light to speculate on rate cuts, pushing Treasury yields down. Gold managed to claw its way back above the $1,980 an ounce region, taking full advantage of the renewed weakness in the dollar and real yields. The buyers have been out in force ever since the banking episode, which changed the landscape for gold by solidifying expectations of rate cuts and smashing yields lower. It was a different story in stock markets. The warning signs of manufacturing did not scare the S&P 500, which closed higher with some help from energy shares storming higher after OPEC announced plans to axe oil production. Overall, the atmosphere in equities remains sanguine as the liquidity taps have been reopened now that the Fed's balance sheet has started to expand, undoing several months of quantitative tightening. The Australian dollar rose almost 2% from its lows yesterday against its U.S. counterpart. This move retraced a little after the Reserve Bank of Australia hit the stop button in its tightening cycle earlier today. The RBA kept interest rates unchanged and broke protocol by indicating it could remain sidelined indefinitely, introducing an element of uncertainty about whether further tightening will be needed. Coming up next is the Reserve Bank of New Zealand rate decision on Wednesday. A quarter-point rate increase has already been fully priced in, with traders also pricing some chances for a larger move. The Kiwi dollar will be driven mostly by whether the RBNZ mimics the RBA and signals this might be the end of the tightening cycle, which seems unlikely, judging from the strength of domestic data. Thank you for watching today's Daily Market Comment here at XM.com.